A bank that survived 2 world wars, the Great Depression, and 167 years of financial crises died in 4 days. Credit Suisse held $575 billion in assets on Thursday, March 16, 2023. By Sunday, March 19th, the bank was gone, sold to UBS for $3.2 billion, a 99% destruction of value. The Swiss government forced the sale to prevent Switzerland's second-largest bank from collapsing Monday morning and taking the country's financial system with it. But Credit Suisse's death wasn't sudden. It was a slow bleed that started years earlier. The bank had been dying since at least 2021, when Archegos Capital collapsed and Credit Suisse lost $5.5 billion in a single week. That loss was just the beginning. Over the next 2 years, scandals, losses, and management failures piled up until depositors lost confidence completely. When the panic started in March 2023, Credit Suisse had no defense left. The collapse of Credit Suisse shattered one of finance's most sacred myths: Swiss banking is safe. For generations, Switzerland represented stability, discretion, and security. Swiss banks survived everything. But Credit Suisse proved that even a century and a half of history means nothing when confidence breaks and capital flees. This is the story of how Credit Suisse, founded in 1856 to finance Switzerland's railroad expansion, became a global investment bank, survived world wars and depressions, and then destroyed itself through reckless risk-taking and incompetent management. How Archegos was the wound that wouldn't heal. How scandals from spying on executives to money laundering for drug cartels eroded trust beyond repair. And how Swiss regulators, faced with systemic collapse, forced a merger that created a banking monopoly and ended Switzerland's 2-pillar financial system. Understanding Credit Suisse matters because it showed that no institution is too prestigious, too old, or too important to fail. The Swiss government couldn't save Credit Suisse. They could only arrange its sale to prevent immediate catastrophe. And in doing so, they wiped out $17 billion in bondholders' money, a decision that shocked global markets and changed how investors view bank debt forever. Credit Suisse was founded in 1856 by Alfred Escher, a Swiss politician and railroad pioneer. The bank's original purpose was financing Switzerland's railroad network as the country industrialized. Over the next century and a half, Credit Suisse grew into one of the world's largest banks, with operations across investment banking, wealth management, and asset management. By 2023, Credit Suisse employed over 50,000 people worldwide and managed trillions in client assets. The bank served ultra-high net worth individuals, corporations, and institutional investors. Credit Suisse was a pillar of Swiss finance alongside UBS, together forming the foundation of Switzerland's banking sector. But beneath the prestigious facade, Credit Suisse had been mismanaged for years. The bank's problems weren't secret, they were public, repeated, and catastrophic. What made Credit Suisse's collapse remarkable was how many disasters the bank survived before the final one killed it. The rot became undeniable in March 2021 when Archegos Capital Management imploded. Archegos was a family office run by Bill Huang, a former hedge fund manager who had previously been banned from trading in Hong Kong for insider trading. Huang used total return swaps, derivative contracts that gave Archegos exposure to stocks without actually owning them, to build massive concentrated positions in companies like Viacom, CBS, and Discovery. The leverage was insane. For every dollar Archegos had, the firm controlled $5 to $10 of stock exposure through these swaps. Prime brokers like Credit Suisse provided the financing, holding the actual shares as collateral while Archegos made leveraged bets on price movements. As long as stock prices went up, everyone made money. When prices fell, the whole structure collapsed instantly. In late March 2021, Viacom CBS announced a stock offering that diluted existing shareholders. The stock price fell sharply. Archegos faced massive margin calls it couldn't meet. The firm's total positions exceeded $100 billion across multiple prime brokers. When Huang couldn't post more collateral, the banks had to liquidate, selling tens of billions in stock into a falling market. Goldman Sachs and Morgan Stanley moved first. They saw the danger and dumped Archegos positions quickly, taking minimal losses. Credit Suisse hesitated. The bank's relationship managers didn't want to anger an important client. Risk officers' warnings were overruled. Credit Suisse held positions for days hoping for recovery while other banks were already out. By the time Credit Suisse finally liquidated, prices had collapsed further. The bank lost $5.5 billion. The loss was staggering not just for its size, but for what it revealed. Credit Suisse's risk management was catastrophically broken. The bank had given one family office enormous leverage on concentrated positions without proper oversight. When crisis hit, internal politics prevented decisive action. Credit Suisse chose relationship preservation over risk management and paid $5.5 billion for that choice. The Archegos loss forced Credit Suisse's chairman and several executives to resign. Investigations revealed that risk officers had warned management about Archegos exposure, but those warnings were ignored. The bank's culture prioritized revenue over risk. Relationship managers were incentivized to bring in business, not question it. This cultural failure would prove fatal, but Archegos was just one scandal in a long series. In 2020, Credit Suisse was caught up in the Greensill capital collapse, another multi-billion-dollar loss from financing a questionable firm that eventually failed. Greensill was a supply chain finance company that lent money to businesses against their future receivables. The business model looked sophisticated but relied on questionable loans to companies with deteriorating credit. Credit Suisse had created investment funds that bought Greensill's loans and sold them to clients as safe, liquid investments. When Greensill collapsed in March 2021, the same month as Archegos, those funds froze. Clients couldn't withdraw their money. The investments, marketed as low risk and liquid, proved to be neither. Credit Suisse faced $10 billion in exposure and countless lawsuits from clients who had trusted the bank's due diligence. The Greensill disaster revealed the same pattern as Archegos: inadequate risk management, revenue prioritized over caution, warnings ignored. Credit Suisse had relationships with Greensill's founder and wanted the lucrative fees from creating and managing the investment funds. Red flags about Greensill's lending practices were dismissed. When the collapse came, clients and investors paid the price. Before that, in 2019, Credit Suisse was revealed to have spied on its own executives. The bank hired private investigators to follow Iqbal Khan, a senior executive who had resigned to join UBS. Khan noticed he was being followed and confronted the surveillance team. The incident became public and spiraled into a massive scandal. The spying was ordered by Credit Suisse's chief operating officer, apparently with the CEO's knowledge. The rationale was paranoia about Khan potentially recruiting other Credit Suisse executives to UBS or sharing confidential information. But the execution was bizarre and illegal. Private investigators followed Khan through Zurich streets. When caught, the surveillance team fled. The whole affair made Credit Suisse look dysfunctional, paranoid, and willing to break laws over petty internal rivalries. The scandal forced both the COO and CEO to resign. Investigations followed. Switzerland's financial regulator FINMA condemned the bank's conduct. The damage to Credit Suisse's reputation was severe, not from financial losses, but from revealing a corporate culture that was rotten at the top. Leadership willing to spy on executives leaving for competitors suggested deep institutional problems. The money laundering scandals were even worse. Credit Suisse was fined repeatedly for failing to prevent money laundering. In 2021, a Swiss court convicted the bank of allowing a Bulgarian cocaine trafficking ring to launder money through Credit Suisse accounts. This was the first criminal conviction of a major Swiss bank in decades. The reputational damage was immense. Each scandal chipped away at confidence. Clients started moving money. Wealthy individuals who had banked with Credit Suisse for generations began diversifying to other institutions. The bank's stock price fell steadily from 2021 highs to multi-decade lows by early 2023. By late 2022, Credit Suisse was visibly struggling. The bank reported 4 consecutive quarters of losses. Billions in client assets flowed out as depositors and investors lost faith. Credit Suisse attempted multiple restructuring plans, cutting jobs and selling assets, but nothing stopped the bleeding. In October 2022, Credit Suisse raised 4 billion Swiss francs in emergency capital. The Saudi National Bank became a major shareholder, investing 1.5 billion francs. This capital raise was supposed to stabilize the bank and fund a turnaround. It didn't work. Losses continued. Client outflows accelerated. Then, in early March 2023, regional banks in the United States started collapsing. Silicon Valley Bank failed March 10th. Signature Bank failed March 12th. The banking crisis was suddenly global news. Depositors everywhere started questioning whether their bank was safe. Credit Suisse, already weak, became an obvious target for panic. On March 14, 2023, Saudi National Bank's chairman gave an interview that triggered catastrophe. When asked if the Saudi bank would invest more capital in Credit Suisse if needed, the chairman said no. The bank was at regulatory limits and couldn't increase its stake. The statement was factually accurate but catastrophically timed. Markets interpreted it as Saudi Arabia abandoning Credit Suisse. The message was clear. If Credit Suisse's largest shareholder wouldn't support the bank, why should anyone else? Credit Suisse's stock collapsed. The price fell over 24% in a single day. Credit default swaps, insurance against the bank's default, spiked to levels indicating imminent failure. Depositors started withdrawing funds en masse. Over the next few days, more than 120 billion Swiss francs fled Credit Suisse. The bank was hemorrhaging cash. Swiss regulators watched the crisis unfold with horror. Credit Suisse held 575 billion in assets. If the bank failed Monday morning, Switzerland's financial system would face catastrophic damage. The country's reputation as a safe haven for wealth would be destroyed. Decades of carefully built credibility would evaporate. By Thursday, March 16th, Swiss authorities knew Credit Suisse couldn't survive the weekend without intervention. The Swiss National Bank announced it would provide up to 50 billion francs in liquidity support to Credit Suisse. This was an emergency lifeline to keep the bank operating while a solution was found. But liquidity wasn't the problem. Confidence was. No amount of central bank money could restore trust once depositors wanted out. The only solution was a sale. UBS was the obvious buyer, Switzerland's other major bank and Credit Suisse's longtime rival. But UBS didn't want Credit Suisse. The bank was toxic. The liabilities were enormous. The risks were unknown. UBS would only consider a purchase with massive government guarantees and protections. Swiss officials spent the weekend negotiating frantically. The government, Swiss National Bank, and financial regulator FINMA worked with UBS and Credit Suisse to structure a deal. The pressure was immense. If no agreement was reached by Monday morning, Credit Suisse would open insolvent. Bank runs would accelerate. The contagion could spread to UBS and other Swiss institutions. Switzerland's entire banking system was at risk. The negotiations were brutal. UBS executives knew they had enormous leverage. Switzerland needed UBS to save Credit Suisse more than UBS needed the acquisition. UBS demanded massive concessions, government guarantees covering potential losses, central bank liquidity support, legal protections from future litigation. The Swiss government had no choice but to agree. The alternative was systemic collapse Monday morning. Credit Suisse's board had no leverage at all. The bank was hours from failure. Depositors were fleeing. The stock price had collapsed to levels indicating bankruptcy. Management's only choice was accepting whatever terms UBS offered or watching the bank die Monday. There was no negotiating position. This was surrender. Throughout Saturday and Sunday, officials worked through complex legal and financial structures. Credit Suisse had operations in dozens of countries, hundreds of billions in assets and liabilities, countless counterparties and contracts. Merging it into UBS over a weekend required emergency legal powers and regulatory shortcuts that would normally take months. Swiss authorities invoked crisis provisions, allowing them to bypass normal merger approval processes and shareholder votes. Late Sunday evening, March 19th, the deal was announced. UBS would acquire Credit Suisse for 3 billion Swiss francs, roughly $3.2 billion. For a bank with 575 billion in assets and 167 years of history, the price was shockingly low. Just months earlier, Credit Suisse's market value had been over 10 billion francs. The weekend sale captured less than a third of even that depressed valuation. The Swiss government provided 9 billion francs in guarantees to cover potential losses UBS might face from Credit Suisse's bad assets. The Swiss National Bank provided 100 billion francs in liquidity support, an amount exceeding Switzerland's annual government budget. The scale of intervention showed how desperate authorities were to prevent collapse. But the most shocking element was what happened to Credit Suisse's AT1 bonds. These were a specific type of bank debt called additional Tier 1 capital, bonds designed to absorb losses if a bank faced severe distress. Credit Suisse had 17 billion Swiss francs of AT1 bonds outstanding. In the merger deal, Swiss regulators decided to write down these bonds to zero. Bondholders lost everything. This decision was unprecedented and explosive. Normally, in a bank failure or acquisition, bondholders rank above shareholders. Bonds are supposed to be safer than stock. But in Credit Suisse's forced sale, shareholders received something. UBS stock worth about 3 billion francs, while AT1 bondholders got zero. The hierarchy was inverted. The rationale was that AT1 bonds, by design, are meant to absorb losses in a crisis. The terms explicitly allow regulators to write them down if the bank faces insolvency. Swiss authorities argued that Credit Suisse was effectively insolvent without the UBS deal, so writing down AT1 bonds was legally justified. But global markets reacted with shock and anger. Billions of dollars in AT1 bonds issued by other European banks sold off immediately. Investors realized that these bonds, marketed as relatively safe instruments, could be wiped out even when shareholders got paid. The entire AT1 bond market was thrown into chaos. Banks across Europe faced higher borrowing costs as investors demanded risk premiums for holding debt that regulators could zero out at will. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion, done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse. Before banks freeze, before governments confiscate, before inflation devours your savings. While you can still access it at https://pay.hotmart.com/B1033628117E. The merger closed quickly. By Monday morning, Credit Suisse was gone. The bank's name, its brand, its identity, all absorbed into UBS. Employees faced massive layoffs. Thousands of jobs were eliminated as UBS consolidated operations. The two-pillar Swiss banking system, Credit Suisse and UBS competing as separate giants, was finished. UBS now dominated Swiss banking with no serious domestic rival. Switzerland had a banking monopoly. For Credit Suisse's shareholders, the losses were devastating. The stock had traded above 80 Swiss francs as recently as 2021. By the merger, shareholders received UBS stock worth about 1 franc per Credit Suisse share. Investors who believed in the bank's turnaround plans or hoped for recovery lost nearly everything. For bondholders, especially AT1 holders, the wipeout was total and shocking. 17 billion francs gone. Pension funds, insurance companies, and individual investors who held Credit Suisse AT1 bonds as supposedly safe income-generating assets lost everything overnight. Lawsuits were filed immediately, but legal remedies were uncertain. The Swiss government had acted under emergency powers to prevent systemic collapse. Courts would take years to determine if bondholders had legitimate claims. The Credit Suisse collapse had multiple causes, but the rot started at the top. The bank's leadership took excessive risks chasing returns. They ignored warnings from risk managers. They prioritized revenue over prudence. When problems emerged, Archegos, Greensill, money laundering, management failed to implement real reforms. The culture never changed. The bank's business model was also flawed. Credit Suisse tried to compete as a global investment bank while also serving as a Swiss wealth manager. These businesses require different cultures, different risk appetites, different expertise. Credit Suisse excelled at neither. The investment banking division took reckless risks that blew up repeatedly. The wealth management business couldn't overcome the reputational damage those disasters caused. Regulatory failures also played a role. Swiss authorities knew Credit Suisse was troubled for years, but didn't force decisive action until crisis was imminent. The bank was allowed to continue operating, raising capital, and making promises of turnaround even as problems multiplied. When intervention finally came, it was too late to save the bank, only arrange its sale. The Archegos loss in 2021 was the turning point. That $5.5 billion hit revealed Credit Suisse's dysfunction so clearly that confidence never fully recovered. The bank tried to move on, implement reforms, and rebuild trust, But the damage was done. Every subsequent scandal, and there were many, reminded markets that Credit Suisse couldn't manage risk. The bleeding never stopped. The speed of the final collapse was remarkable. From the Saudi National Bank interview on March 14th to the forced sale March 19th was 5 days. But the underlying deterioration took years. Credit Suisse was a zombie bank long before March 2023, losses mounting, clients fleeing, stock price collapsing. The final crisis just forced acknowledgement of what had been true for years. Credit Suisse was unfixable. For Switzerland, the merger created profound problems. UBS now holds over 1.6 trillion francs in assets, more than twice Switzerland's GDP. If UBS faces crisis, the Swiss government cannot bail it out. The bank is too large. Switzerland's economy couldn't absorb UBS's failure. The country is now hostage to a banking monopoly it was forced to create to prevent immediate disaster. The Credit Suisse collapse also damaged Switzerland's reputation as a financial safe haven. For generations, Swiss banking meant stability, security, and discretion. Credit Suisse's failures, money laundering, spying, incompetent risk management, shattered that image. And the government's decision to wipe out AT1 bondholders while saving shareholders shocked global investors. Switzerland prioritized preventing systemic collapse over honoring traditional creditor hierarchies. That decision was legally defensible but reputationally costly. The broader lesson from Credit Suisse is about the fragility of institutional prestige. 167 years of history meant nothing when confidence broke. Credit Suisse survived the Franco-Prussian War, World Wars I and II, the Great Depression, multiple global financial crises, and then destroyed itself through poor management and reckless risk-taking in the span of a few years. The bank's age and reputation couldn't save it when clients and investors decided the institution was broken. Credit Suisse also proved that banking crises in the modern era move with terrifying speed. Silicon Valley Bank failed in 48 hours. Credit Suisse died in a weekend. The traditional playbook for managing bank failures, arranging orderly sales over weeks, negotiating terms carefully, doesn't work when capital can flee globally in hours. Swiss regulators had to force a deal in days because waiting meant collapse. The AT1 bond wipeout created a precedent that will haunt European banking for years. These bonds were supposed to be relatively safe instruments, riskier than senior debt but far safer than equity. Credit Suisse proved that regulators will zero them out to save a bank, even while shareholders get paid. That inversion of normal creditor hierarchies made AT1 bonds far riskier than investors believed. Every bank that issues AT1s now faces higher costs and skeptical investors. For UBS, acquiring Credit Suisse was both opportunity and curse. The bank gained market share, client assets, and eliminated its main Swiss rival. But UBS also inherited enormous risks, legal liabilities, bad assets, integration challenges. The Swiss government provided billions in guarantees, but even with that protection, absorbing Credit Suisse will occupy UBS for years. And the monopoly position makes UBS systemically critical. If UBS fails, Switzerland has no backup plan. Credit Suisse's employees faced devastation. Thousands lost jobs as UBS consolidated operations. Many had worked at Credit Suisse for decades, believing in the institution's stability and prestige. The bank's collapse destroyed careers, retirement savings invested in Credit Suisse stock, and professional identities. The human cost was immense. March 19, 2023, marked the end of Credit Suisse and the end of Switzerland's dual-pillar banking system. 167 years of history ended not with a dramatic failure, but with a forced weekend sale arranged to prevent Monday catastrophe. The bank that financed Switzerland's railroads, survived world wars, and represented Swiss financial strength for generations was gone. Absorbed, erased. The collapse reminded everyone that in banking, confidence is everything and history is nothing. Credit Suisse's century and a half of operations couldn't save it when depositors wanted their money back and shareholders lost faith. The prestige, the tradition, the Swiss reputation, all irrelevant once the bleeding started and couldn't be stopped. And the precedent is terrifying. If Credit Suisse, a global systemically important bank with 167 years of history, can die in a weekend, which banks are actually safe? The answer increasingly is that safety in banking is an illusion maintained only as long as everyone believes it. When confidence breaks, even giants fall. This is decoded economics. Subscribe to see the collapse before it happens.